Welcome back to Grow Wealth with Audie. Before we dive into today's topic, we want to remind you that if you find value in this video, please consider hitting the like button and subscribing to the channel. It's the best way to support the community we're building here.
Content on Grow Wealth with Audie is for educational purposes only and is not professional financial, investment, or legal advice. Our team are not financial advisors. Investing involves risk. Past performance does not guarantee future results. Always consult a licensed professional before making financial decisions.
Welcome back to the deep dive. Our mission today is, well, it's all about turning that technical jargon into some real strategic clarity.
Right.
We're opening up your sources, a really high-octane technical analysis of the SPY ETF. That's the main S&P 500 tracker. And we're focused squarely on the one-day chart.
Yep.
We're going to distill this thing down to its absolute essentials. Where does the trend stand? What does this recent pullback actually mean? And what are the critical levels you absolutely have to watch?
People often say charts are just noise. But if you apply a few key technical filters, that noise, it really starts to turn into a clear language.
A language, exactly.
And we're focusing on, let's say, three main dialects today. First is the price structure itself, then the story that the candlesticks are telling us right now, and finally a sort of health check from our core indicators.
Okay.
That's going to be the 50-day moving average, what it's just called the 50 MA. Then the Bollinger Bands, or BBs, for volatility, and the Relative Strength Index, the RSI, which is our momentum gauge.
Exactly. And these tools, they aren't just lines on a screen. They're a shortcut to understanding the market psychology. They tell you where profit takers are hiding and where buyers might be getting ready to step back in.
That's the whole game.
So let's unpack this initial snapshot, the big picture. Since that really sharp sell-off low back in April 2025, SPY has just been an absolute beast. I mean, the foundational trend is still resiliently bullish.
Oh, without a doubt.
But clearly, the market's signaling a pause, a tactical pause. Momentum is cooling off, and it's cooling off fast.
And that's the crux of it right there. You have to manage this internal conflict in the chart. The bigger picture bias, the foundational trend, it's still strong.
Right.
But the short-term tactical bias, it's turning bearish, and it's signaling real trouble ahead if some key support doesn't hold.
Okay, so let's dig into that structure.
Let's start with that foundational trend. I mean, since that deep low in April, SPY has been painting a classic textbook uptrend, a clear sequence of higher highs and higher lows.
The definition of bullish.
It is. And that structure is the essential context. It means that every pullback you see should, historically be seen as a buying opportunity until that structure of higher lows is broken.
Right, that's the optimistic view.
Yeah.
But what really stands out to me in this analysis is the conflict. The trend is, as you said, beautifully bullish, yet the latest candlesticks are flashing this huge warning sign of selling pressure.
Yeah.
How do we reconcile that immediate fear with the long-term optimism? Is this just, typical noise, or is something more structural going on?
That is the right question to be asking. And the short-term action suggests it's something more structural. It's related to distribution.
Distribution.
Yeah, for weeks, the price just stalled out. It kept hitting a ceiling right around the 690 to 700 area. This formed a distribution zone.
Okay.
Things are like a crowded exit ramp after a long, fast road trip. Instead of accelerating, the market just got congested. And we started seeing sellers, the smart money, quietly offloading their positions.
Into the enthusiasm of the late buyers.
Exactly. So that ceiling defined the top of the range. And now we're seeing the market correcting, and correcting aggressively from that ceiling.
Precisely. The latest move is a decisive pullback that started right from the top of that range.
And the candles confirm it's not a quiet consolidation. Not at all. The rejection near the highs was followed by a very strong big red pushdown day.
And that strong red candle is the market ringing the alarm bell. It's doing it loudly, especially because the source notes confirmed it printed on above average volume.
That volume is critical. I mean, a down day on low volume, you can often just ignore it. It's passive selling. But a strong down candle on high volume is the market's way of saying supply is stepping in with conviction at resistance.
So it's not just a drift lower.
Not at all. It signals that profit-taking is significant and professional sellers are asserting control. When volume follows direction, you have to pay attention.
Okay, so we've established the underlying trend is up, but the immediate action is, let's say, Highly suspicious. And it's backed by professional selling volume near that 700 psychological ceiling. So we need to check the indicators to see how much damage this selling has actually done to the uptrend's health.
Yeah, if the price action is the diagnosis, the indicators tell us where the critical support is. So let's start with the one level that matters most right now. The 50-day moving average.
The 50 MA.
We call it 50 MA. It's the yellow line on the chart, the primary pullback support line for a reason. Institutions, major funds, they use the 50 and the 200 to define the health of their trends.
The intermediate and the long term.
Exactly. In a mature uptrend like this one, the 50 MA isn't just a technical line, it's a massive psychological anchor.
And what's fascinating is that this current pullback has brought us right back to it. We're now hovering directly around the 675 to 678 zone. That's where the 50 MA is.
It's the immediate battleground.
Yeah, for the uptrend survival.
It truly is the line in the sand. If you're a buyer, this is where you step in to defend your positions. So this focus on 675, 678, it really defines the two immediate scenarios for you.
Okay, let's nail those down. First, the best case outcome, the healthy pullback.
The healthy pullback outcome, it requires the price to hold the 50 MA on a daily close. And then you need to see a clear bullish reversal candle, confirming that buyers have just absorbed all that selling pressure.
So if 675, 678 holds, the uptrend is basically back on.
Immediately reinstated, yes.
But the more concerning scenario is the failure. If the 50 MA breaks, that's more than just losing a support level. That's a structural failure.
It is a major failure.
Yeah.
The deeper correction risk happens if price decisively closes below the 50 MA. And critically, if it then rallies back up to test that 675, 678 level, and it fails the retest.
It closes back under it again.
It closes back under it.
Yeah.
That's often when the major institutional selling really begins. That specific pattern, the break and fail retest, it signals that the old support is definitively turned into new resistance.
And for SPY, that historically opens the door to what?
It opens the door quickly to a test of the next major zone, which is down around 660 to 665.
Okay, that's a very clear set of outcomes based on just one level. Now let's look at volatility, because it confirms that the prior move was getting stretched.
It really was.
The Bollinger Bands were just screaming overbought recently. The sources noted the market was literally walking the upper band. That signals extreme strength. You just can't keep that pace up forever.
It's that classic rubber band effect. You know, the price got too far out in front of its average, and now it's just experiencing textbook mean reversion. It's cooling off.
The snapback.
Exactly. We're seeing the market rotate back inside the bands from that high peak. The energy that fueled that run is just dissipating.
And this action also gives us another warning sign, right? For deeper weakness. Where do we look inside the bands for that?
You look at the middle line, the 20-day simple moving average, or 20 SMA. If the price holds the 50 MA, the next goal for the bulls is to get back above that 20 SMA. But if price breaks below that middle band and keeps closing below it, that means the short-term trend is dead. And that often accelerates the move down toward the 50 MA and then potentially the lower band and that 660, 665 support.
So the 20 SMA dictates the short-term path and the 50 MA dictates the intermediate trend. Okay, let's move to the engine check. How much momentum is left?
Yeah, how much gas is in the tank? The RSI is our momentum meter. It's pulled back significantly, but it's currently hovering in what we'd call neutral to bullish territory, somewhere around the 50 to 60 area.
And why is that specific reading, say 55, comforting for the bulls?
Because it tells us this is structurally still an uptrend pullback. It's not a trend collapse.
Got it.
I mean, true bear markets are serious damage. That usually involves the RSI plunging deep into the 30s. A 50-60 reading just suggests we're burning off froth, setting up the foundation for the next potential move higher.
But that outlook changes if it stays weak for too long.
Correct. The critical shift happens if the RSI stays below the 50 line for multiple sessions. If momentum gets lost below 50, it suggests a technical shift into a choppier correction, a range.
So instead of a quick bounce, you get weeks of just painful sideways action.
Exactly. Just fighting for balance between that 50 MA and the resistance overhead.
All right, so we've established the critical support at the 50 MA, that 675, 678 zone, and the bigger structural support below that at 660, 665. Let's quickly confirm the ceilings the bulls need to break through.
The near-term ceiling is defined by that recent distribution zone. Bulls have to get over the repeated rejection area of 690 to 695.
The first hurdle.
The first hurdle, and then, of course, the big psychological round number and the all-time high area, 700. To declare this uptrend has resumed, those levels have to be taken out. and on strong volume.
So we have a really clear confined battlefield. It's between 675, 678 on the low end and 695, 700 on the high end. That defines everything right now.
That's absolutely right. The market is just coiled, waiting for a decision.
Okay, so let's put it all together.
Now we synthesize this into a practical decision matrix. But remember the golden rule that ties all of this together. All strategic judgment, bullish, neutral, or bearish, it has to be made based on the daily close.
The daily close, not the intraday noise. Okay, let's start with the best case scenario that keeps this long-term trend going. Bullish continuation.
Okay, for bullish continuation to take hold, we need confirmation at two key junctures. First, price has to test and hold the 50 MA at 675, 678 and print a confirmed bullish reversal candle.
A sign of immediate demand stepping in.
Right. Second, and this is crucial, it must then regain the middle Bollinger Band, that 20 SMA, on a daily close. If you get those two things, the probability is very high that the uptrend is just reset and we're going to challenge 700 again.
What if the market stabilizes but just doesn't have the conviction to attack 700? That leaves us in that middle ground.
That leads to scenario B neutral, the range continuation. The 50 MA holds, which is good, keeps the major trend healthy, but every attempt to move back above 690 just gets rejected.
So frustrating chop.
Frustrating chop. And if you're range bound, your strategy has to shift completely. You're buying near the low end, around 675, and you're selling or even shorting at the high end, around 690, 700. You just have to wait patiently for a clear, decisive breakout or breakdown on a daily close.
And finally, the scenario that forces a real structural change, the bearish deeper correction. We touched on the ingredients, but let's just reinforce that sequence again.
This is the high-risk scenario. It needs two confirmed technical failures. Failure 1, price has to close below the 50 MA. Failure 2, the rally attempt that follows has to fail the retest. It closes below 675 again.
So the buyers are defeated at the most important level.
They're defeated. That sequence validates it, and that plays out. You have to recognize the odds have increased for a rapid move down toward the 660s. That's the next major consolidation area.
And what's really important here is understanding that waiting for that sequence, the close below, then the failed retest, that's the difference between just getting nervous and knowing it's time to actually reduce your risk.
It saves you from reacting to noise. Pure and simple.
So this analysis gives you the full structural roadmap for SPY, from that psychological ceiling at 700 all the way down to the ultimate uptrend safety net at 675.
And before we close, we have to hammer home that crucial trading principle you mentioned, the close confirmation rule.
Yes.
You just can't afford to react emotionally to price swings during the day. If you see the 50 MA being tested, you have to wait for the candle to close to confirm whether support held or if the break is genuine.
Reacting mid-candle is just gambling.
It's technical gambling. Waiting for the close is strategic execution.
That rule really is the line between novice trading and professional risk management. It makes sure the market has finished its statement for the day before you decide to respond.
And here's a final provocative thought for you to consider. If we look at the Bollinger Band and the RSI rotation, we know the market has cooled off. It's done that through mean reversion. If the 50 MA does hold...
So we get that bullish scenario.
Right. If that happens, how might that mean reversion influence the speed of the move back towards 700?
Interesting. So will it be a slow, grinding consolidation near the moving average, building up energy for the next push? Or, because the pullback was so fast and violent, will the force of that snapback, that mean reversion, create a sharp V-shaped recovery that challenges the highs way quicker than anyone expects?
The answer to that will dictate your strategy for entry and for setting your targets. So watch that 50 MA at 675, 678, wait for the daily close confirmation, and just let the structure tell you the story.
That's the deep dive for today. Thank you for joining us as we mapped this critical battlefield for the SPY.